There are two different ways of creating a cash flow or statement of cash flows. I'm not going to get into that because that's just technical accounting. So let me say it this way. If you go run a statement of cash flows in QuickBooks, this is a scenario that most people are more likely to encounter. What you're going to find is at the very top of the statement of cash flows, there is going to be net income. And going back to what I said earlier, the statement of cash flows reconciles net income to cash. So top of the statement of cash flows, your net income for the period. Bottom of the statement of cash flows, your cash balance in your business. And everything in between is just explaining why those two numbers are not the same. It breaks it down into three categories. It gives you cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. The cash flow from operating activities is where it starts. So you have net income. After that, adjustments from operating activities. This is where, again, going back to the same scenario, you have $1 million of net income, but let's say 900,000 of that is still sitting in accounts receivable. You've billed it, you've recognized the revenue, but you haven't collected the cash. You're going to see in the operating section of the statement of cash flows a negative $900,000 adjustment because $1 million in net income that hasn't turned into cash yet because 900,000 of it isn't collected. So to reconcile net income to cash, we have to back out 900,000 from net income. So that operating section takes into consideration all those types of operational adjustments, accounts receivable, accounts payable, credit card payments. All those kinds of things are going to show up as adjustments in that operating section because the timing of when they hit the profit and loss versus when they hit the bank account is different. And it creates a gap that you have to explain. Because credit cards, good example. You swipe your card, it hits the P&L the day you swipe your card. It's an expense. But you're not going to pay that credit card off until the end of the month. Right? So there are timing differences between expenses hitting the P&L and cash leaving the balance sheet. So it gives you your total operating adjustments in the top section and gets you down to net cash provided by operating activities, which is just strictly your net income minus your operating adjustments. Then it goes down to the investing section. This is, think like capital expenditures would be a good example. You spend a bunch of money on service trucks. Those would show up as investing activities, and they're adjustments to cash because they don't hit the P&L. You buy a $100,000 service truck, you put it on the balance sheet as an asset, and then you recognize depreciation expense in the P&L over a long period of time as you use that asset. So you have a $100,000 decrease in cash right away, but almost no expense that hits the P&L yet. That has to be reconciled. That happens in the investing activities. The last section is financing activities. Think of this as funds coming in. You take out a loan, for example. The balance that you received on that loan is going to show up in financing activities as an increase in cash. It doesn't hit the P&L. It goes on the balance sheet as debt. So we have to explain why we had $500,000 in cash increase that never showed up in the P&L. That shows up in financing activities. You net out your net income, your operating activities, your investing activities, and your financing activities, and that all adds up at the bottom to exactly the same number that you have in the bank at the end of the day.